So I was asked to speak today about Solvency II, and for us on the policy side, Solvency II is done. So maybe we should take a step back and look at some of the key milestones in the Solvency II development, and maybe try to find some understanding behind the key question, which is why it took us so long to develop Solvency II. So I will start with a short presentation. Insurance Europe is a federation of insurance associations. We represent the interests of the European insurance industry in Brussels. We are based in Brussels, actually very close to the European Parliament and the European Commission. And we represent 95% of the European insurance market by premium income. Of course, the Solvency II project was a key project for us. It was at the top of the agenda over the past 14 years. This is, the title of this slide is something that we very often use when engaging with policymakers. Good regulation is important for a healthy industry. And I think that that's the objective of all of us to achieve a healthy industry. The industry supported from the beginning the key aims of Solvency II, and just as a parenthesis, the Solvency II project was supposed to be a principle-based project, and I think that we have overachieved this target, looking at the extent of the amount of regulation that we currently have. So the initial key aims of Solvency II were policyholder protection, transparency and high standards of risk management in the European industry, a harmonization of regulations, because you know Solvency I was a minimum harmonization approach, and support for a strong and efficient European insurance industry. Over the past 14 years, a great deal of effort, time and money have been dedicated by the industry in testing solutions, in developing solutions together with policymakers to make sure that Solvency II achieves the best possible outcomes. Why Solvency II has taken so long? And here I will just give very shortly some key insights into some key moments in time. So the Solvency II project was launched in 2000 by the European Commission. And for those of you who are not familiar with the European legislative process, the Commission is the executive body and is the only body that proposes regulation. And once the Commission proposes a regulation, the regulation has to be approved by the European Parliament and by the Council of the European Union. So the Commission announced the Solvency II project in 2000, and from the beginning it said that it's a wide scope review of insurance regulation in Europe, and this is why it actually took the Commission 7 years to draft the first proposal of Solvency II. So this came out in July 2007. It was submitted to Parliament and Council, and then Parliament and Council took another 2 years to discuss it, make changes, and finalize the Solvency II proposal. We have a final Solvency II first proposal in 2009 with implementation date set for 31st of October 2012. Nobody had really tested extensively the proposal, so in 2010, EIOPA, which is the European supervisor, ran what was called the Quantitative Impact Study 5, and I think that some of you in the room have been involved in this Quantitative Impact Study. It was an extensive field testing exercise that also revealed very interesting conclusions. It showed that Solvency II, in its current state, would create enormous balance sheet volatility, would create enormous needs for additional capital for insurance companies, and would basically make long-term products unviable and unaffordable for insurance companies. So it was a clear signal that Solvency II had to change and that the timeline for implementation had to be delayed. In 2011, the Commission set up a task force with EIOPA and also with the insurance industry to basically define and create technical solutions that would address the concerns. Again, it took longer than expected to create these solutions. Initially, we were expecting to be done by 2012 so that we can implement Solvency II 1st of January 2013. This didn't happen. In 2012, we finalized a number of solutions that had more or less the support of EIOPA. These solutions were tested in 2013 in what was called the LTGA, the Long-Term Guarantees Assessment, and it really showed how big the problems would be without solutions in Solvency II. This report was used as basis for kickoff of negotiations between Commission, Parliament, and Council. A political agreement was reached in November 2013. It was not necessarily ideal for the industry. It did not fully reflect the industry proposals for various reasons. However, the industry was, let's say, tired of many years of uncertainty, so just supported the finalization of Solvency II. Then over the past, so since November 2013 up to actually March this year, we have been engaging with EIOPA and with the Commission in finalizing the implementation details of Solvency II, and as you all know, it will be applied 1st of January 2016. So, as you can see, we had 14 years of development of Solvency II, and in retrospect, we actually believe that it would have been difficult to develop and agree Solvency II significantly more quickly. And of course, that the financial crisis was one of the trigger of changes. And we believe that the delays have actually helped us achieve better outcomes and avoid worse unintended consequences. I have two examples on how bad Solvency II would have been without the final solutions. And for those of you who are familiar with the solutions, they are mainly solutions related to valuation of liabilities, the matching adjustment and the volatility adjustment. And I think that the Romanian market will only apply the volatility adjustment. And this shows a company, maybe I will only focus on one example. So we have here an example of an insurance company that has perfectly matched assets and liabilities, a 10 years portfolio. And then in the initial Solvency II proposal, the valuation of assets was completely separated from the valuation of liabilities. During the financial crisis, as you see in gray, the spreads for a AA corporate bond portfolio went up from 60 basis points to 300-something basis points. This created a huge impact on the asset side. However, this was not reflected on the liability side. So this created extremely volatile solvency ratios. And you can see that this company, although it has a very simple portfolio, 10 years, perfectly matched, etc., it has a solvency ratio that goes from 215% to minus 97%. So this company would have actually been taken over by the supervisor unless it would have had capital, or it would have had additional capital to cope with such enormous volatility. So the long-term guarantees impact assessment showed that the measurement, so not the economics of the business, but the measurement, created enormous volatility on insurers' balance sheet that insurers could have not coped with. And then we have another example on the importance of traditional measures, and just the key highlight is that if an insurer finds out today that it might have a problem in 20 years' time, it has 20 years to find a solution or to take action. Previously, Solvency II was basically saying, if you have a problem in 20 years' time, then you should take an action now. And it basically didn't recognize that we have a long-term business model and we should look with a long-term perspective of things, and that the solvency regulation should allow us for time to find solutions to problems that will only arise in the future. Another key question, why it was important to get Solvency II right? Well, the quantitative impact studies have basically shown that long-term products would have become unviable or too expensive. And allowing insurers to continue their long-term approach is vital for policyholders, because policyholders actually need long-term products and also long-term guarantees for financial stability. And this was, again, something that we very much raised with the Commission, because the measurement system, it has to recognize the important role that insurers play in a financial stress situation. In a financial stress situation, everybody wants to sell distressed assets. We are actually the only ones who have a stable flow of premiums, who have enormous amounts of cash and who are actually happy to buy distressed assets because we buy them cheap. Well, the initial Solvency II proposal did not recognize this and actually encouraged us to also take a selling approach in a period of financial stress. So we had to raise these concerns with the Commission and to explain them that unless they fix Solvency II in a way that recognizes the long-term business model, they will basically destroy all the benefits that we produce for the economy. And of course, the long-term approach is very important for the wider economy, and I will come back with some numbers in a few seconds. What are the consequences of getting the balance wrong? So what would have been the consequences of getting Solvency II wrong? Well, one could imagine that some products would have been withdrawn from the market just because insurance companies couldn't have afford offering them. We can think of higher prices for policyholders. In case insurance companies decided to offer those products, the high capital volatility would have had to be reflected in the prices for policies. And of course, it would have encouraged the wrong and procyclical behavior. And now we have two exhibits that we actually produced ahead of finalization of Solvency II, and we believe that they are very powerful, and policymakers, whenever they make decisions affecting our long-term business model, they should have these numbers in mind. And if you look in Europe, insurance companies are the largest institutional investors. In 2012, we've had 8.4 trillion of assets under management. In 2013, this was 8.5. And you can see we have the double of pension funds and much more than all the other institutional investors. And for those of you who wonder where are banks or why banks are not listed here, well, first, banks are not institutional investors. Second, the total value of banks' balance sheet is somewhere around 46 trillion, but these assets are short-term, not long-term. So again, this should make a huge difference for policymakers. And this 8.5 trillion represent more than 55% of European GDP. Again, an exhibit that we produced ahead of finalization of Solvency II. 80% of our assets actually back long-term liabilities. And these long-term liabilities create the ability for us to invest long-term. And you can see what kind of role we play. For instance, insurance companies hold 21% of all European corporate debt. We hold more than 25% of all European government debt. We hold impressive amounts in infrastructure, in direct SME loans, in private equity, in securitizations. And all these assets are actually key for European growth and for the agenda of the new European Commission, which is focused on growth and investment. So to wrap up, Solvency II is a huge change and improvement compared to Solvency I, and I think we heard earlier some comments about how policyholders should feel. Well, definitely they should feel much safer, because if anything, Solvency II is overly conservative calibrated. And we see that Solvency II changes everything, changes the valuation. We go from a cost accounting valuation to a market-adjusted valuation. In Solvency I, we had a very simple factor-based approach for measuring risks. In Solvency II, we have either sophisticated internal models or a complex standard formula covering 28 risk types. In Solvency I, we had the solo approach. In Solvency II, we have a group approach. In Solvency I, we had relatively low minimum solvency requirements. In Solvency II, we have high minimum solvency requirements and extremely high solvency capital requirements. We had little governance and risk management in Solvency I. We have extensive governance and risk management in Solvency II. We had limited reporting in Solvency I. In Solvency II, we have more than 271 reporting templates to be finalized in July. And we understand that on top of these templates, national supervisors, and we already heard yesterday from the Romanian supervisor, additional reporting templates would be added to reflect local market specificities. Regarding supervisory power, well, in Solvency I, we had limited powers to intervene before actual failure. In Solvency II, the ladder of intervention comes before, significantly before any material risk of failure is obvious. And now the interesting part, or the challenging part, is that in Solvency I, we had 199 pages of legislation. Again, it was a minimum harmonization approach, while Solvency II has more than 3,500 pages of regulation that we have to implement. What does this create for us? Well, first of all, it creates implementation challenges. The industry has always argued that it needs at least 18 months for implementing Solvency II. And as we are all aware, it's not final. The reporting templates will be out in July, and we are still negotiating with EIOPA some deadline for financial stability reporting, for example. And of course, that it will create significant costs for the industry. And I'm not sure whether an estimate has been produced for the Romanian market, but the UK Treasury did an estimate for the UK market, and that estimate is £4.2 billion. And of course, that this is expected to have an important impact on the net benefits of insurance companies. Looking ahead, Solvency II is not perfect, does not represent the industry ideal solutions, is very conservatively calibrated. However, the industry is committed to the current timetable. It will be important looking ahead to monitor for unintended consequences and to raise concerns with the European Commission whenever such concerns emerge. And actually, Solvency II has embedded a review process to fix outstanding issues over time. And we will for sure engage with the industry on finding out what these issues are and trying to find solutions for them in the future. Beyond Solvency II, just wanted to highlight the fact that on the financial regulation side, and again, this slide doesn't include anything related to conduct of business, consumer protection, and there we have a lot happening at Commission level, and you will see some very interesting proposals on regulation of how we sell business, what kind of disclosures we make to our policymakers, etc., in the coming years. So this is just the side of financial regulation, and it's either directly impacting the insurance industry, like IFRS 4 Phase 2, again, a never-ending project, one could say. Hopefully, we'll finalize it soon. But then we also have rules for banks, for resolution of banks, and these again affect us. And why they affect us? Because we hold bank debt, and we want to know what will happen with this debt in case we have a failure or a resolution case in Europe. So I would focus just on another two examples. Solvency II is done, but then last year we have started discussion on a much wider project, which is called the International Capital Standard. And this is an ambitious project that aims to create a global solvency system. And just for reference, this is something to what the banks did with Basel back in the 80s. We are still at a very preliminary phase with this. And of course, that a number of questions emerge. Like, will this ICS replace Solvency II? Will it look like Solvency II? Will it look more like the American system? These are all questions that will probably be answered in the coming years, but like many years to come. And the second item, because I think, or I guess there could be some reinsurers in the room, we are also very much engaging with the European Commission, because we know that in some countries around the world, there are increasing limitations on the ability of European reinsurance to place business. And we've seen protectionist trends in South America. And just to give you a recent example, in Ecuador, the government, in order to prevent the exit of foreign currency, they imposed a 95% compulsory retention rate. So basically, the doors are shut for European reinsurers. We also see developments in China, which is a big market for us, where they're implementing a new solvency system similar to Solvency II, but this new solvency system is very discriminatory with respect to European reinsurers. And why? Because the Chinese government wants to encourage the emergence of local reinsurers. So on all these areas, we are engaging with the European Commission. We are raising with them our concerns so that they can use our concerns in their negotiating their trade agreements with these countries. And just to conclude, how difficult is it to get the regulatory balance right? Well, it's actually very difficult. And we've seen that with Solvency II, but we see it with many other regulations. And just looking at the first comparison, should regulation, or actually we don't write regulation that is too simplistic, we also don't write regulation that is too complex. And one of the reasons why the industry's package for Solvency II was not considered acceptable to European supervisors was the fact that it was deemed too difficult to be supervised. So on the international side, we are currently developing an approximative balance sheet to make comparisons across international groups. And there we would argue that the approximation is too simplistic. So the regulatory exercise is really not easy. But we believe that it's vital to get the right balance, and it's vital for the insurance industry, for the role that it plays in the European economy. Policymakers should focus on getting the balance right, and the design and application of insurance regulation, be it financial regulation or any other form of regulation, be it at European level or at national level, you should focus on identifying and achieving the right outcomes. And trust me, this is not this is not an easy exercise, on avoiding the unintended consequences and on considering the impact that these regulations can have on the economy. Thank you.